Good evening, everyone. Sorry for the delay. It took some time to set it up at this new place, so that's why there is a delay. So today we'll cover two standards, simple ones, but you know they are not often tested in the examination. But whenever they are tested, you can get good marks out of it. So that should be the intention of learning these two standards, and nothing complicated. Very simple principles that we need to follow. And I hope the screen is clearly visible, and my video and audio are also good because I've tried a new setup today, so that's why I just wanted to cross confirmation. Right. So in days 2 on inventories, and if you have learned AS2, there is hardly any difference apart from uh, okay. Yeah. Now AS2 on inventories, or Ind AS 2 on inventories. This standard applies to all the inventories except financial instruments we know covered by 32 and 109. Biological assets related to agricultural activity and agricultural produce at the point of harvest. So wherever we have biological assets which are related to agricultural activity and agricultural produce at the point of harvest. Now here what we need to understand is you have agricultural activity, and because of the agricultural activity at some point of time you have harvest. For example, you grow paddy and you harvest rice and all of that. At the point of harvest, you get some amount of produce. I think there is some buffering reported by users. Just a moment. That's good. Okay. So, at the point of harvest, whatever produce you get, let us say you get rice grains. Now, these rice grains are not directly covered under inventory. Okay. Till the time or at the point of harvest, whatever you get the rice grain, you cover them under Ind AS 41. Subsequently, this forms part of your Ind AS 2. So, at the point of harvest, you will measure them as per Ind AS 41, and subsequently you will measure them as per Ind AS 2. Then measurement of inventory is held by, now please understand we are talking about measurement. Recognition criteria will still apply, measurement criteria will not apply in case of producers of agricultural, forest products, mineral, to the extent they are measured at NRV in line with industry practice. Commodity broker traders who measure inventories at fair value less cost to sell. So this is the basic scope that we need to understand as far as Ind AS 2 scope is concerned. Now, what are inventories? These are assets, so you need to meet the criteria of an asset, which are held for sale in the ordinary course of business. So whatever you are selling in the ordinary course of business, that is inventory. This is the finished goods. Then work in process, if at all it is held in production for such sale, then also it's inventory. In the form of materials or supplies to be consumed in the production process, so let us say you need some lubricant oil or something like that, those are also inventory. Or you need raw material, those are also inventory. Now in the examination, whenever they ask questions, very few times they have asked the questions, whenever they ask questions in the examination, when they say value of inventory, you need to calculate raw material, WIP, finished goods, if the information is available. If the information is not available, then whatever is there, based on that you can calculate inventory. Now the golden rule that you need to remember is inventories are measured at lower of cost and net realizable value. So the standard thing that you need to remember is inventories are measured at lower of cost and net realizable value. One thing you have to keep in mind, this for raw material we will have a slight exception. Now this is very simple to understand. All of us know that inventories are valued at lower of raw material, lower of cost and NRV. It is simple to understand. It is not complicated. What happens is at the time of calculation, it becomes really difficult. Students face difficulty at the time of calculations of cost or net realizable value. Sometimes they get confused with replacement cost. So all of these things we will cover when we do this particular standard. Cost, whatever we have learned in our Ind AS 16, similar principles will apply here. All the cost, purchase price, import duties, if input is available or if credit is available or if refund is available, you will not consider them, right? So you will take the purchase price, other duties, transport, any cost to bring the inventory to the present location and condition you will consider, and you will deduct trade discounts, rebate and similar discount. Cash discount is not reduced, only trade discount is reduced. This time there was a good question in RTP where they have given volume discount. So volume discount you will definitely reduce, right? This is cost of purchase. So this basically takes care of what? My raw material. Now if I need the finished product, this raw material has to go through a process which I say cost of conversion. So in cost of conversion you have direct labor, other direct cost and overheads, fixed as well as variable overheads. So these are the things that you will consider in cost of conversion. Now when it comes to overhead, what you need to keep in mind is we always calculate something called as predetermined overhead rate, recovery rate, that is estimated overhead divided by budgeted output. Okay, so you will determine a overhead recovery rate, and based on this fixed overhead are recovered. On this also there is a variation of question where if it is less than if the production is more than the capacity, what is to be done? If the production is less than the capacity, what is to be done? That is what we will understand. Then any cost that is incurred to bring the inventories to the present location and condition is included. Borrowing cost, if permitted under Ind AS 23, will be included. You might be wondering, sir, which borrowing cost will be included? See, if something like there is, let us say, wine. Now, longer the wine, the better the quality of wine. So in that case, it may qualify as an asset, and as per Ind AS 23, we may capitalize them, right? Now, as I told you, we calculate something called as predetermined overhead recovery rate, budgeted fixed overhead divided by planned or normal production. Now, if the normal production is less, you will use the same rate. If the normal production is more, you will recalculate the rate. Or if the actual production is more, you will recalculate the rate. So, if the actual production is greater than the planned or normal production, you will recompute the overhead recovery rate. If it is less than the planned production, you will use the predetermined ORR. So, your cost of inventory is cost of material plus cost incurred in direct labor and overhead. This includes both variable plus fixed. Fixed, if it is more actual output is more than the plan, then recompute, otherwise use the predetermined ORR. Right. Now, net realizable value. What is net realizable value? Say for example, the estimated selling price is 100. So there is something which is work in progress. Estimated selling price is 100 and estimated cost to complete is 20. So we'll reduce this. Estimated cost to sell, let us say commission is 10. So NRV becomes 70. So net realizable value is estimated selling price of the inventory minus any estimated cost to complete the inventory and estimated cost to sell the inventory. And as we said, you will always measure inventory at lower of cost and net realizable value. Then when we calculate or when we compute cost versus NRV, you will do it on item to item basis and not on global basis. For example, if you have A, B, C, cost is 100, NRV is 80. Here cost is 80, NRV is 90. Here cost is 70, NRV is also 70. Now what you will do is 100 versus 80, you will measure at 80. 80 versus 90, 80 and 70. So 80 plus 80, 160 plus 70, 230. You will not say 100 plus 80 plus 70, 250 and 90 plus 80 plus 70, 240. So we'll take 240. No, this is not correct. Item by item basis you have to do. Now, when we estimate NRV, you should take the reliable evidence that is available on the balance sheet date. Okay. What happens in the future is a future event, so you may not consider or you will not consider in for the future event. Events occurring after the balance sheet date should be considered to the extent they provide additional evidence of events existing on the balance sheet date. So, should we consider post balance sheet date? Yes, we should consider post balance sheet date events, but they should provide additional evidence of events existing on the balance sheet date. Price reduction in future should not be considered. On the balance sheet date, let us say it is 100, subsequently we sold at 80, this should not be considered because this is not existing on the balance sheet date. And lastly, if there is a firm contract to sell, means there is a contract that the company has entered into to sell the product, then the price can be considered as an evidence of net realizable value. Right? Now, sometimes what happens, moving on to the next aspect of joint products and byproducts, sometimes what happens is you use a single raw material. With the single raw material, you get multiple products. Let us say you get petrol, diesel, kerosene. This point, so you use a single material, crude oil, you take it through the process and you create multiple output. Now the question is, the cost of crude and the common cost of processing crude, how should we allocate? So what the standard says is, you have to consider this joint cost and allocate them on the basis of the sales value at split off. Whatever is the sales, this is called the split off point. Whatever is the sales value at the split off point, on that basis you will allocate the joint cost. So joint costs are allocated on the basis of relative sales value NRV at the split off point. Now how do we calculate that? Just I'll do working for you. Now let us say common cost 10,000. We have two products A and B. At split off, sales value is 150 for this and 250 for this. So how do you split that? 10,000 into these two ratios. So this becomes 400. So what do you do? 10,000 into 150 divided by 400 will be for A, and 10,000 into 250 by 400 will be for B. That is how you will do the allocation. Okay. Now sometimes the sales value at split off point may not be available, but you have final selling price. Say for example 200, 300. Then what you will do? Final selling price minus further processing cost is equal to NRV. So I have final selling price 200. Let us say 20 rupees is the cost after split off point. So what I will do, 200 minus 20, 180 becomes my NRV at the split off point. So you will always estimate the NRV at the split off point of the joint products. Now sometimes you have byproducts also. These are something like scrap. Now how do we allocate the cost of scrap, or how do we allocate the realization from scrap? Whatever is the scrap value, which is low value, that is reduced from the joint cost if they are immaterial. If the byproducts are material, they will be considered as joint products. So if I get scrap when I do the processing of crude, what will I do? The realized value of scrap I will reduce from the joint cost. Sometimes that is also taken as other income. That is also perfectly fine. Right. Now, so far what we have understood, inventory is measured at lower of cost and net realizable value. Be very careful in the examination to calculate the cost and net realizable value. Though it appears to be a simple question, lot of students make mistake in the examination. Somewhere they will miss direct material, somewhere they will miss direct labor, fixed overhead recovery rate, especially when the actual production is more than the plant production. This part, when actual production is greater than the plant production, you have to recompute the overhead recovery rate. So that aspect also you have to keep in mind. Okay. Now, once they had asked a question based on this also, retail method, that is expected sales value minus normal gross profit margin. So how do we measure the cost? How do we measure the cost? If you have lots of inventory, let us say you're looking at a departmental store, so there what you will do, you have or you find out what is the MRP, for example, and let us say your normal gross profit margin is 20%. So 100 minus 20 rupees, 80 becomes my cost. Simple calculation. Or you can also use the standard cost method that you would have learned in costing to calculate the value of material, labor, overhead, and based on the capacity utilization. Now, when you have lots of inventories, the other thing is, how do I value the inventory? Here, how do I compute the cost? Here, how do I value the inventory? Now, if you have multiple products that comes up, if the inventory is not ordinarily interchangeable, something like let us say customized work or something like job work, let us say customized furniture and all of them, when inventory is not interchangeable, the product that I have produced, I cannot exchange with the another product. If someone has given me order for a furniture, their furniture I cannot exchange with the other furnitures, right? So here you have to do the specific identification of cost, meaning to say for the customized work, for the job work, whatever cost is being incurred, that is what you have to consider in the calculation of the cost of inventory. So for example, for the furniture, what is the value of wood gone, what is the labor? For each job, you have to specifically identify. This is only applicable when inventory is not ordinarily interchangeable. If it is ordinarily interchangeable, then you can use FIFO method, weighted average method, standard cost method, or retail method. So standard cost we have seen here, retail method we have seen here. Then we have FIFO and weighted average method. Now FIFO and weighted average method, if you have to see, I'll just pull up my Excel and share the screen with you. Just a moment so that I can explain you. Just a moment. Just give me a moment. The file is taking time to load. Okay, when it loads, I'll definitely share the screen with you. Uh, where we'll understand FIFO and weighted average. Now, FIFO method, please understand, in the assumption is first in, first out. Means we are assuming whichever material comes first, that will be sold out first. So, if you have, let us say, first batch, second batch, third batch, like this, you will assume that first you will sell from the first two batches, then if anything is required, you will sell from the third batch. Now, if you see the closing inventory will be from the recent batches. Then the second one we have weighted average method. Now, weighted average method is basically you take the total cost divided by total units. You take the total cost, you divide it by total units to get the weighted average rate, and based on the weighted average rate, you calculate the closing inventory. Okay, and based on that, you will calculate the cost of goods sold as well. Now, raw material. We have understood that the valuation of material is lower of cost and NRV. Right. Now, what the standard says is the raw material value valuation will be at cost. Normally, raw material valuation will be at cost. Why not at NRV, or why not at lower of cost and NRV? See, raw material is not something that you sell. Raw material is something that you consume in the production process. So, you don't have NRV. So, you'll value at cost. But if the finished goods selling price is less than cost, if the finished goods selling price is less than cost and there is a decline in price of material, you will value them at replacement cost. Don't think that this is lower of cost and replacement cost. No, that is not the situation. What you need to understand is, it is if, for the first condition, selling price should be less than the cost. Second condition, there is a decline in price of material. Then you will value it at replacement cost, which is an indicative of NRV. But if selling price is greater than or equal to cost, then you will not consider replacement cost. You will only value it at cost. Even if the value of raw material is declining, even in that case, you will not value it at replacement cost. You will value it at cost only. For example, what I am trying to tell you here is, what I'm trying to tell you here is, let us say its cost is 100. Cost of raw material is 100. Cost of finished goods, after considering all the material conversion and all of that, this is 150. Selling price is 200. Now in this case, you will always value the raw material at cost only. Even if the replacement cost is 80 or 70 or 60 or 50, you will value it at cost only. That's the first thing. Okay. Now, second scenario. Cost is 100, this is 150, selling price is 120. Selling price is 120. Now, if the selling price is 120, which means I am not recovering my cost, which means I have to calculate what is the replacement cost. The replacement cost, let us say, is 80. Then the standard says write it down to 80. Write it down to 80. If the replacement cost is 120, continue to carry it at cost only. Nowhere you will take it above cost. You will always value it at lower of cost. You will always value it at replacement cost if the selling price is less than the cost. Means you are not able to recover the cost of finished goods. Any question? Are you clear with this? Here is where a lot of students make the mistake. Now, if you look at the FIFO and LIFO method, not LIFO is not permitted, sorry, FIFO and weighted average. If you look at FIFO method, let us say on 1st of January of 23, purchased 100, rate, amount. Purchase 100 at, let us say, 50, amount is 100 into 55,000. Then on 12th of January of 23, again purchased, let us say 50 at the rate of 60, this became 3,000. Now when you sell under FIFO method, when you sell, you will sell, let us say you sold 70. Okay. Now if you have sold 70, while calculating closing stock, how much is the closing stock now? You purchased 100, then you purchased 50, total 150. You sold 70, so your closing stock is 80. Your closing stock is 80. If your closing stock is 80, as per the FIFO method, you will say first in, first out, means first lot we will sell first. So out of 100, 70 is sold. Out of 100, 70 is sold. So 30 you have at 50, which is 1500, and 70, sorry, 30 you have at 50, 50 you have at 60, that is 3000. So the value of inventory will be 4500. That is how we will calculate the value of inventory when FIFO method is being followed. Now if weighted average is followed, then what we will do is, here we will say while calculating weighted average, what we will do is we will sum up the quantity 150. You will sum up the value 8000, and then you will calculate a weighted average rate, that is 8000 divided by 150. What you get is 53.33. So closing stock will be 80 into 53.33, that is 4266. So the way you value inventory has a huge impact on the profit, because inventory changes, your profitability changes, right? So here that is what you have to keep in mind, how to calculate under both the method. And please note, when you calculate the weighted average can be periodic weighted average or a moving weighted average. Moving weighted average means after every purchase you will update the weighted average calculation. Periodic weighted average means total cost divided by total number of units, you will get the weighted average calculation for that period. Now of course, the entry that you pass, purchases to creditors, you have to change your mindset, and now you have to say inventory to creditors. As and when you sell the product, whatever is the amount of inventory sold, what we say cost of goods sold, this is recognized as expense. When you write down to NRV, means if cost is 100 and NRV is, let us say, 80, we'll measure it at 80. This 20 is also a loss. And reversal of write down, if you have written down something in the past and now you are reverting it back, that is recognized as a gain in the P&L. Sometimes inventory may be used for construction of property, plant and equipment. In that case, you will consider the value of the inventory used in capitalization of property, plant and equipment. Let's look at some questions from the study material. In a manufacturing process of mass limited, one byproduct VP emerges besides two main products MP1 and MP2. I don't know how many times this question has been covered in intermediate classes, in the accounting examinations, in final examination, the earlier ones. One of the most tested questions, I would say, apart from the scrap. So you have one byproduct, you have one scrap, and you have MP1 and MP2. The cost of production process are given below. Raw material 14,500 units, amount 1,50,000. Output. So you got raw material. Output is main product 1, 5,000 units. Closing stock is 250. Then MP2 output is 4,000 units. Closing stock is 100. Byproduct is 2,000 units. Raw material 1,50,000, wages, fixed overhead, variable overhead. Average market price of MP1 and MP2 is 60 per unit and 50 per unit. Byproduct is sold at 20 per unit. There is a profit on 5,000 on sale of byproduct after incurring separate processing charges of 8,000 and packing charges of 2,000. 5,000 was realized from the sale of scrap. So what has happened? From sale of scrap, you have got 5,000. That is one. Then second thing is, you sold the byproduct at 20 per unit. So how much byproduct were there? 2,000. So you sold it at 2,000 into 20 per unit, and you got a profit of 5,000 on sale of byproduct. What are the additional expenses you incurred? 8,000 on processing, 2,000 on packing, and 5,000, only these two, 8,000 and 2,000. So 10,000 was incurred, and ultimately you made profit of 5,000 on sale of byproduct. Okay. Now calculate the value of closing stock MP1 and MP2 as on 31st March of year 1. Now, the selling price of byproduct is 40,000, 2,000 into 20. Separate processing charges of 8,000 and packaging charges of 2,000 is what you have incurred. So, NRV of byproduct is 30,000. NRV of byproduct is 30,000. Now, this net realizable value of byproduct, what we will do is, either we can take it to other income or you can reduce from joint cost. Similarly, whatever is the value of scrap, that value you will reduce from the joint cost. So, raw material, wages, fixed overhead, variable overhead is the total cost. NRV of byproduct is 30,000. That is what we have realized. Sales of scrap 5,000. The total is 35,000. Joint cost that you will allocate is 3,20,000. On what basis? On the basis of relative sales value at split of time. Now here one mistake what students can do is, they will take 60 is to 50. No, you have to take the total sale value. What is the total sale value of MP1 and MP2? Based on that, you have to do the allocation. Now, if you see the total sale value, 5,000 and 4,000 into 60 into 50, this is the total sale value. In this ratio, you will allocate the joint cost of 320. Now, the cost per unit is this. Closing stock, you have multiplied with cost per unit, you will get the value of the closing stock. This one you can once practice on your own. Illustration number 7. This one is very simple. You have already seen it has to be done on item by item basis and not on a group basis normally. Okay, so that's it from with the point of view of Ind AS 2. Let us now look at Ind AS 41, that is agriculture. Any question? Small standard, but yes, you can score pretty well if at all a question is tested. Do look at the RTP question, a very comprehensive one. I have solved it in the RTP video itself, and very comprehensive. All the items listed, and sometimes we'll scratch our head and say what should be included or what should not be included. Just give me a moment. I'll share the screen for Ind AS 41. Again, a very small standard, but I don't know. One thing what I was surprised me is I don't know how many companies in India would be applying Ind AS 41, but time and again questions have been tested. Value the calf and pigs and goats and whatever it is. But yes, this is Ind AS 41 on agriculture, where we will see how do we account for agricultural activity and biological asset. So one simple concept that you have to keep in mind and not forget is it is based on fair value less cost to sell, or cost to dispose, you can say cost to sell. Whatever valuation of agricultural produce, biological asset covered under Ind AS 41, the valuation principle is fair value less cost to sell. Okay, that is one thing you have to keep in mind. Now, you will apply this standard for all biological asset if they relate to agricultural activity or following activity when the biological asset. Now, please remember, bearer plants Bearer plants related to agricultural activity, these are covered under Ind AS 16 and they are not covered under Ind AS 41. This detailed discussion we already had in Ind AS 16. Government grants related to bearer plants, because is related to bearer plant, it is covered under Ind AS 20. Government grants related to agricultural activity will be covered here. Intangible assets, if you have any, or if you have any land, or if you have any building, etc., you'll cover by Ind AS 16 and Ind AS 40 and Ind AS 38 respectively. Very important. Bearer plants are covered under Ind AS 16. Now, biological assets, we have already seen the definition and all. Basically, living animals or plants, living. Okay. So all of these are biological assets. The produce from sheep is wool, timber is trees, the fell trees, dairy cattle, the milk, and all of this. And now what you also need to understand is agriculture produce, wool, milk, carcass, all of these are covered by 41. At the point of harvest, you will measure them as per Ind AS 41. But after that, if you do some further processing, if you do some manufacturing activity, all of that will be covered by Ind AS 2. That is the linkage between 41 and 2. So, for example, if you have, let us say, harvested cotton, the value of harvested cotton will be determined by 41. But if you subsequently manufacture it, threads and all of those things, this will be covered by Ind AS 2. Now, what is covered here? Anything related to agricultural activity, that is your agricultural produce, your biological asset, and your government grant. What is agricultural activity? It is the management of biological transformation and harvest of biological assets. So, management. Please understand, if you are managing, if you are rearing cattle, if you are rearing chickens, hen and all of those things, if you are planting trees, all of that is agricultural activity. But if you go to a pond or a natural lake and you just carry out the fishing activity, that is not called as agricultural activity. There has to be an active management of biological transformation. Now, what is this biological transformation? When you rear chickens or when you rear hens and all of that, the biological transformation is the laying of eggs and hatching into chickens, right? So when you do this biological transformation, increase the biological asset, that is what is called agricultural activity. Biological asset, as we said, is living animal or plant. What is biological transformation? Growth. So it will increase the quantity, right? So there is growth, then degeneration, decrease. So there would also be degeneration. Production of agricultural produce like milk, wool, etc. And procreation, creation of additional living animals or plant. So when there is a tree, it can grow. That is in the aspect of growth. Procreation means you have additional units like cow gives birth to a calf and all of that, right? So that is called biological transformation. Now, most important for us is fair value and cost to sell. Fair value is the price that will be received to sell an asset or paid to transfer a liability. For us, it is only an asset. So when we sell an asset, what is the value that we will realize? That is called fair value. And cost to sell is the incremental cost directly attributable to disposal of asset. Now, whether a calf is born or whether a calf is purchased, you will measure at fair value less cost to sell. And the balance sheet date, fair value less cost to sell. Bearer plant is covered under Index 16, we have already seen. Now, recognition criteria for biological asset. When the entity controls the asset, probable future economic benefits, fair value or the cost of the asset can be measured reliably. Same principles what we learned under Index 16, similar principles are applicable here. How do you measure biological asset? Initial recognition, fair value less cost to sell. Subsequent, fair value less cost to sell. Agriculture produce, fair value less cost to sell at the point of harvest. Subsequent is covered by Index 2. Now, what do we do with the gain or loss? See, for example, your cost is 1000. Fair value less cost to sell on the balance sheet date is 1200. Now, the gain of 200, what do we do? This gain of 200 will be taken to P&L. So, gain or loss on initial recognition is included in P&L. This is also included in P&L. Change in fair value less cost to sell on the reporting date is also included in P&L. Simply put, whenever you recognize any item of agricultural produce or biological asset on the date of initial recognition, you will take fair value less cost to sell. If there is a gain, recognize in P&L. If there is a loss, then also recognize in P&L. Now you may have, why is it that there will be a loss? So what happens is, maybe you have bought at 1000, for example, and you incurred some transportation cost of 100, so 1100 is the cost. Fair value is 1000, cost to sell is, let us say, 50, so this becomes 950. So this is one unique standard where at the initial recognition also we may have loss. Okay, so that is where it is done. Now, government grants, similar principle that we'll understand in government grants, that if there is a unconditional grant, you recognize in P&L. If there is a conditional grant, you recognize in P&L when the conditions are met. Okay, so here we'll focus. This is the crux of the standard. There is nothing great for us to understand here, as far as I think pretty blur. But I hope you have understood the explanation. I think due to some network issue, it has become blur. Okay. Okay. Uh, so we'll take a few questions. Or what I'll do is, because I think I'm facing this network issue, the screen is blur, and even if I write something, it may not be very clear. For India's 41, selected 3 or 4 questions, I'll render them separately and I'll provide to you in the YouTube channel and also in the WhatsApp group, which you can practice. Uh, Please understand, the concepts are very simple. Just 3 principles that we understood. How do we value the biological asset, agricultural produce, and government grant? What you need to understand is carefully you have to calculate. Okay, that itself will help you solve the questions in the examinations. Right. Thanks a lot, and we'll continue tomorrow at again 7:30 with the next standards.